I want to hammer on one very, very, very important point. In 68 to 82, I'll keep referencing that because it's just an easy period where the market went nowhere for 14 years. But during that period, the economy in real terms grew above trend. Think about that. The market went nowhere in nominal terms and in real terms lost 67% of its value for 14 years during a period where the economy, adjusted for inflation that was really high, grew above trend.
Initial conditions.
Correct. The market is not the economy. People take those two things to be like every single person. I think a retail investor, you go talk to them. We're gonna have above trend economic growth. They'd be like, "Well, gotta go buy stocks." That's not how this system works. Okay, and that's why fundamentals are not a good predictor of equity market returns. What is a good predictor of equity market returns is amount of money in investors' hands, the amount of money on corporate, balance sheets to buy right stocks, and that is more a function of liquidity than it is a function of earnings. I sat down with a friend of mine who's a partner at Vista Equity Partners, a big private equity firm. Their businesses are booming. They're in the technology space too. Technology stocks are in the gutter, but guess what? Their portfolio companies are crushing it. Their cash on cash returns are increasing, and adjusted for inflation, even more so. So the talk is consistently about, are we going into recession? Are we not, as it relates to the market?
I know it's comical.
It has nothing to do with what's important here. What's important here is, again, I think demand will continue to be more resilient than people expect. We're running a demand side economy. We're sending money to people, and that's driving higher GDP. But guess what? We've been in record price to sales valuations, right, for some time, and record margins for some time, right? Those things are going to normalize.
Yeah.
And they're going to normalize because interest rates are going higher. So the resources are more expensive, right? Resources, whether it's labor via globalization or technological advancement or, they've all been cheap. Money's been cheap. Labor's been cheap. Commodities been cheap. Well, when that starts to change, margins compress. Price to sales may increase, but that doesn't mean earnings are going to be better across the whole economy, right? And that definitely means as interest rates go higher, not only do you have less money chasing assets in general, but you have, because of the reverse Tina effect, now money flowing to bonds, and there's just less demand, so multiples contract. So that combination of margin compression, multiple contraction, can be very, very powerful during what might otherwise be a relatively good economic period, and particularly for the median outcome, might be actually a net, very strong outcome, right? Maybe very positive. So I just think it's important to get your head around that. Everybody plays this. What's the economy going to do? Let's invest in good businesses, right? Go buy good cash flow, discounted cash flows, which have not mattered really for 20 years, or at least, for the most part, like current cash hasn't mattered, right? At least adjusted for a long-term cost of money. Haven't mattered, but that's going to matter a lot more. So this whole value growth rotation that we saw for 40 years, growth just dramatically killed value, and every value manager has been either liquidated or long since given up. Guess what? That's going to work again. It's going to matter because cash is more valuable, and you can generate cash when others can't, and others can't borrow money anymore. You get to buy those companies when there's that malinvestment gets liquidated. You get to reinvest in buying your own stock and doing other things when other companies can't. I think that's another major trend to be focused on.
That's a huge point. I mean, earnings growth of the S&P was actually almost identical in the two periods from, that 65 to 81 period. And the 81 to 99 period, the earnings growth of the S&P was 7% in both cases. The challenge was the initial conditions in both cases was very different. And the inflationary experience, right? You started, 82 conditions were a PE multiple of 9 and inflation was at 10%.
Right.
the other is, 65 starts at a 23 multiple and inflation at 2%.
Yep.
Any of this ringing any bells for anybody? Should we ding, ding, ding right
Yeah.
there?
And this is why the Schiller PE works, right? This is why people have been kind of, again, we extended that cycle because of, again, monetary policy. And it took a while for this kind of, the pressures of normalizing interest rates to take hold. But you can't fight gravity at the end of the day forever.